Hello, my name is Jack Elder, Senior Director for Advanced Planning for Comprehensive Brokerage Services. This is part two in a two-part series on premium finance rescue. So in my last installment, we talked about and emphasized the threats to premium financing transactions, and those are the fact that caps are declining and that even though interest rates have been very, favorable and very low, providing ample opportunity for arbitrage, positive arbitrage over the last 10 years, that is changing because as of the spring of 2022, we had increasing interest rates. So we have a combination of falling caps on IUL, rising interest rates on the premium finance loans, leading to the potential for negative arbitrage. So that's that recaps my last video. And we are seeing at CBS lots of cases coming to us where clients are concerned. And for example, meet Linda. She's currently 53, bought the policy when she was 51. She purchased a premium policy 12 years ago. She's not completely tuned into the fact that caps have come down on her policy because she's had positive arbitrage, but she is tuned into the fact that interest rates are increasing, and that is a concern. In fact, she started the refinancing process, and the interest rate has jumped from low threes to mid sixes. So she's very concerned. So policy details. It's a current face amount of, call it $14.7 million, current surrender value at 3.1. The current debt's 2.6. So the policy's in game position. The policy's done well for itself. But if you factor in the high interest rates that she's going to be paying in the future, she's really concerned. So her net face amount is 12 million, backing out the debt, and her net cash value is 532,000. And our job is to help her figure out what her alternatives are. And there's really two macro alternatives with, that you can break down into two parts each. So you can, pay the loan. One entails paying off the loan from the policy and keeping the coverage. And you could do that with a policy loan or a policy withdrawal. Or you could do the exact same thing, policy loan, policy withdrawal, whichever one is optimal, better for the client, given their risk profile, followed by 1035. So we'll call that the no out-of-pocket options, no more out-of-pocket. And then alternatively, you could freeze the loan. What I mean by that is you're not going to take any more loans out. You're going to, continue to pay interest and keep the same coverage until some point in the future. And this is being recommended by a lot of the premium financing shops out there. This is what they're showing. That's the main thing. Alternative to that, you could pay off the bank loan, and then the amount of money you were ready to contribute in interest payments as you kicked the can down the road until until the interest rates leveled out or caps increased or, cash values were sufficient to pay off the loan. Whatever amount was illustrated in interest, pay off the loan and use that money for premiums on a new policy. And we'll call that one the pay interest versus pay premium in a new policy. So let's look at each one of those. We'll start with the zero out of pocket comparison. So we've developed this deliverable. So it takes the two alternatives and it says, okay, alternative number one, let's pay the bank loan off with a policy loan or a withdrawal, depending on the client's situation, and keep the same coverage and have no out of pocket, kind of like, let's escape from the premium financing, take the exit before the interest rates get us on the refi and hold serve. And that's what this design does. Okay. So no more outstanding bank loan, no more concern about forecasting interest in the future, no out of pocket because we're going to, just put a tourniquet on this bad boy, no more collateral risk. If in this case, in this real case, this client, that was what they're leaning towards. They were, and then, you play that out at age 84, you're looking at almost 4 million, 3.9 and change death benefit. But note that because you're paying off a loan with a loan, there's still, risk involved here. And she was very interested in minimizing risk. So we looked at using a withdrawal, and it really just brought the policy down to like such a minuscule level. It didn't make sense. But look at that death benefit; it's still shrinking. So the red line there, that's her current policy. What we showed her is an alternative where we rolled that cash value over and made no more premium payments. So if you compare the two, the green line at her life expectancy, she's 125 percent better off from a wealth transfer perspective, and that's $850,000 more of coverage. And oh, by the way, and I'll show this, it's got a longer guarantee on the new policy. It's got a more conservative crediting rate. It's going to be better for her, in a bunch of different ways. So here's the new policy, right? Again, no financing on this one. So no bank loan, no interest, we're not doing anything out of pocket. We're just going to roll that cash over, no collateral risk. That 532 in cash after paying off the loan, because in this case, we used a withdrawal, an internal withdrawal, and rolled over the cash value. We did not carry the loan over. It didn't make sense to mirror it on the other side. And it paid for a death benefit, a level death benefit, 4.2 million going all the way out, which, by the way, that 4.2 million means that her family's 25% better off. There's a longer guarantee on this policy. The death benefit stays level, and we've eliminated 100% of the interest rate risk. And that was her concern. Now, her husband thought they should continue making contributions because they're going to have taxable estates. So we ran that version as well. And if you look right here, this is their current policy. So this is the freeze the loan alternative, where you're just going to not make any more premium payments, not take out any more loans, but just pay interest on what you have. And then someday, pay off the loan. And they illustrated it at age 75, which in essence, we're looking at 24 more years of premium financing. So we didn't think that's a very good idea. It could be the best idea in a particular situation, but here we had an alternative, and that was to pay off the loan with a withdrawal, roll the cash over to a new policy, and then the amount you were going to pay in interest, actually less than that, put it into the new policy. So let's compare the two with a little bit more detail. At age 84, at client's life expectancy, they'd be 146% better off, just significantly more. That's $5.5 million more in death benefit. So to deep dive on that, this is their current policy: keep the same coverage, freeze the bank loan. So they're paying interest. So note the death benefit there. Note the interest rate forecast. That's a reasonable interest rate forecast. Maybe it's even a little bit rosy, but it's so. But we're putting real numbers in front of the client for them to make a decision. And we pulled those numbers from the SOFR forward curve, and then we just applied the that's what the out of pocket's going to be. That's your interest obligation to the bank. And note that's 24 more years of interest rate risk, 24 more years of premium financing. Note there, age 76, 77, the reduction in the death benefit, and that pays off the loans. Okay. So then you're out of the loans, kind of a few years after retirement. There are many years after retirement for this family. That would give them at life expectancy a $14 million policy, but we can do better. So if we were to take the cash value after paying off the loan with a withdrawal, not a loan, so we're eliminating tons of risk by doing that, then we roll the cash value over, buy a policy with a level death benefit, and then remember the amount we're going to pay in interest if we continue to premium finance. We're going to pay less than that. Okay. So less than we would to freeze the loan, less than the SOFR forward curve. We're just going to do a 20 pay for an amount less than what we were forecasting. And it gets us a $17 million death benefit, which is $5.5 million more than keeping the other policy with a longer policy guarantee. Death benefit stays level, and we eliminate a lot of that performance, 100% of that interest rate risk and performance risk. So in this case, replacement was a better option. We are finding it's not always a better option. Sometimes it's better to freeze the loan and do and just kind of forage into the future. Other times you're going to use outside money to pay off the loans. Sometimes you got to surrender your insurance. We're seeing the gambit, but many times we're able to use the policy. If the policy's got a few years behind it, you can pay off the loan often and then either keep that policy or look at a new one. The key is to provide the client with side-by-side alternatives, and the pages you've seen from that spreadsheet is robust. It looks at this from every possible perspective. So really quick, here's how the side-by-side is highlighted with these graphs, but the no out-of-pocket comparison, the current, is in red, the 1035 is in green, and which one's better. It's easy to see for the client. If they think they have normal longevity, they would do the 1035. And then same deal with the continued contribution comparison. So if you're going to be contributing, blue is interest, right? We're going to take a number less than that to a 1035 and contribute premiums. We'll get you more death benefit with a lot less risk, right? So that's the comparison if you want to continue to make contributions. The key with a premium finance review is using realistic projections, that it's comprehensive, meaning you look at this in a bunch of different ways, not just, hey, continue to pay interest, or hey, take a loan from your policy. Maybe those aren't the alternatives. And that is what we are seeing from the premium finance shops. These alternatives need to be put side by side in an easy to understand format so the client can make a good, educated, smart decision for themselves. So we'd be more than happy to look at any premium financing cases on a complimentary basis that you'd like us to take a look at. We're here to help. You can either email me or call. I'd be happy to help you. CBS Brokerage. And by the way, we're pro premium finance in the right situation. And we're here to help. So with that, have a great day. Thank you very much.